What if I told you that the financial system you trust every single day is literally designed to keep most people broke? Or, actually, at the very least, that the biggest, most exciting stock launch in human history was deliberately engineered to make you overpay? Welcome to The Explainer. I'm here to break down the cold, hard reality of the financial machines that run our world.
Today, we're diving deep into the SpaceX IPO. Now look, this explainer isn't about whether SpaceX is a good company or not. It is, obviously, right? They're landing rockets from space. It's literally the future. But what we're going to unpack today is the machine behind the stock. A very specific, very deliberately designed system that turns your genuine excitement into the most expensive purchase you will ever make. Once you see the mechanics of this thing, you won't be able to unsee it.
Let's jump right into part one, the cost of hype. We're going to start with a story, a very real scenario that played out for millions of retail investors on June 11th, 2025. Meet Marcus. It's 6:47 a.m. Marcus is sitting at his kitchen table. His coffee's getting cold, but he doesn't even care. For the past 10 minutes, he's been furiously, repeatedly refreshing his brokerage app. And then, boom, the moment arrives. The stock goes live. The price shoots up, fast, like uncomfortably fast. Marcus hits the buy button. He locks in at $204 per share. His heart's racing. It feels like he just made the absolute smartest decision of his life. He owns a piece of the future. But wait, let's hit the brakes for a second and look at the reality of that transaction. The people selling those exact shares to Marcus at $204, yeah, they bought those very same shares just one day earlier at $135. Same exact company, same future. They just paid $70 less, literally 24 hours ago. Marcus wasn't early, he was last. And for the privilege of not missing out, he paid a staggering 51% premium.
Which brings us to part two, the trillion-dollar machine. To understand how Marcus ended up holding the bag, we need to look at the cold, hard math of the machine that made this possible. Let's talk about launch day. SpaceX launched its IPO at $135 per share. In a single day, it raised $75 billion. Then the underwriters exercised what's called a greenshoe. It's essentially a bonus round allowing them to sell even more shares. That brought the total raise to $85.7 billion. It completely crushed the previous record holder, Saudi Aramco. It was the largest in human history.
And what did that historic raise do to the company's total valuation? It pushed it to $1.77 trillion. A trillion, with a T. From day one, that placed SpaceX among the 6 most valuable companies in America, standing shoulder to shoulder with giants like Apple, Microsoft, and NVIDIA, companies that have been practically printing money for decades. Meanwhile, in 2025, SpaceX generated $18.7 billion in revenue. That's real, growing, and incredibly impressive for a rocket company. But when you pay $1.77 trillion for $18.7 billion in sales, you are paying roughly 94 times revenue. Let me be absolutely clear here. Not earnings, revenue. That's the money coming in before a single expense is even paid. Let's put that in context, right? The average company in the S&P 500 trades at around 3 times sales. Even Palantir, a company widely considered extremely expensive by Wall Street standards, trades around 73 times sales. SpaceX came in at 94x, and after the retail pop, it pushed well past 100x. When you buy at those multiples, you aren't paying for the company as it is today. You're paying for the company as it might become if absolutely everything goes perfectly for the next decade. That is not investing. That is writing fan fiction with a brokerage account. And here's the part the CNBC countdown clocks didn't tell you. Last year, on standard accounting, SpaceX recorded a $4.9 billion loss. Let that sink in. A massive deficit. And since its founding in 2002, it has accumulated roughly $41 billion in total lifetime losses. You've got a company that has spent almost its entire existence burning capital, and it's now being assigned one of the biggest price tags in global finance. Let's move to part 3, scarcity and forced demand. So how can a market possibly sustain these numbers? Because the machine knows its job very, very well. The first piece of the puzzle is a concept called a thin float. When SpaceX went public, they didn't offer the whole company to the market. They only brought about 4% of the company's shares to the public. The other 96% stayed locked away. Listen, when very few shares are available and the entire world wants to buy them, the price absolutely skyrockets. It isn't magic, it's engineered scarcity. The underwriters took a massive crowd of global demand and funneled it through a single tiny door. That engineered scarcity is just one part of a 4-part hype machine. First, you have the thin float we just discussed. Second, you have forced index buying. Because SpaceX's valuation is so massive,
It automatically qualifies for major indexes like the NASDAQ 100. Index funds don't get to choose what they buy. Every single fund tracking it is forced to buy in, bringing billions in mechanical, automatic demand layered right on top of that tiny supply. Third, you have the $17 billion first-day pop. The gap between the $135 IPO price and the early trading value created instant paper gains, but most of that value was captured by institutions with priority access, not retail traders. Which brings us to the fourth part, retail excitement as the product. The countdowns, the media hype, the thin float, it's all perfectly designed to convert your excitement into the highest possible entry point.
Let's dive into part 4, the illusion of control. When you buy into a machine like this, driven purely by the fear of missing out, you surrender a lot more than just a premium price. You surrender power. Let's talk about the hidden dangers here. SpaceX utilizes a dual-class structure. Public shares, the ones our guy Marcus bought, get exactly 1 vote each. Elon Musk's shares, they get 10 votes each. Musk controls roughly 82 to 85% of the total voting power. What does that mean for you? It means you are not a decision maker. You're a passenger. He can merge the company, pivot it entirely, or invest billions into totally unrelated AI projects, and public shareholders have absolutely zero power to stop it. And then we really have to talk about the lockup. Remember that 96% of shares that were kept off the market? They're currently restricted from being sold. But over the coming months, those insiders are going to gradually be allowed to sell their shares to the public. History is incredibly consistent on this point. When a flood of new supply hits the market, that engineered scarcity disappears. Prices usually soften. And those sellers flooding the market, they bought in much earlier, at prices far, far lower than what you see on your app today. This is where we have to have a serious conversation about risk. This isn't just some theoretical warning. Look at history. Overhyped, expensive, low-float IPOs often perform the absolute worst in the years following their launch. Let's look at some historical IPO crashes. Facebook fell 50% after its IPO. Rivian, down 95%. Coinbase dropped 90%. Robinhood plummeted 92%. These were not scams. They were beloved, highly anticipated companies. But early buyers paid a brutal price for FOMO.
Now, yes, sometimes it works out like Tesla. But I want to remind you that even the people who won with Tesla had to endure a 60% drawdown and multiple 30+% crashes along the way. Most retail investors simply do not survive that ride. So the question isn't whether SpaceX is the next Tesla. The real question is, could you emotionally handle your portfolio falling 50% twice? Because that is exactly what that level of volatility looks like.
This brings us to part 5, surviving the hype cycle.
So how do we navigate this? How do we find the massive opportunity without basically just funding institutional exits? Well, the expert analysts over at Morningstar recently ran the numbers, and they estimate that the true fair value of SpaceX sits well below these astronomical IPO hype levels. Their message to the market is simple, clear, and highly effective. Wait for the excitement to cool. If SpaceX truly is the dominant, world-changing company we all think it is, it will absolutely still be there in a year, or 2 years, or 5 years, trading at a much more reasonable, math-based price. And that brings us right back to Marcus. He bought a few shares at $204 because it felt like owning a piece of the future. But he paid the excitement tax. In the financial markets, there is absolutely no trophy for catching the exact peak of the hype cycle. True profit goes to the patient investor, the one who's willing to stand back, watch the madness, run the cold hard numbers, and let others pay the premium. Be that person. Patience over panic. Because the ultimate question isn't whether you want to own the future, it's whether you want to be the one overpaying to fund it. Will you wait and let others pay for the hype?